Good evening and welcome back to the latest edition of the InvestTalk market analysis for the week ending June 3rd, 2022. Thank you all for tuning in and subscribing to this channel as well as our podcast, InvestTalk. Now this week I am going to title the video, Consolidation Brings Market Calm for Now. And I'm going to start with the economic numbers because there were a lot of economic numbers this week. It was non-farm payroll week. And remember the first Friday of every month, and that was today. And we had a disappointing jobs number, about 390,000 jobs created. Worse than expected, but not horrible. Certainly, we're creating jobs, so that's the good thing. But we're kind of in this bad news is good news because the market is more focused on what the Fed is going to do and policy going forward. And so the market actually wants to see economic deterioration now so the Fed can react to it by not tightening policy as much as they're promising. It's kind of the way the market's thinking right now. So it was kind of some ways good news is bad news, okay? Or sorry, bad news is good news in this case. Now, some other good news for the Fed was that labor force participation rate ticked up here. Now, not a lot, but after ticking down in April, in May, you got to tick up. And that's what the Fed wants to see. The Fed wants to see people going out there and looking for jobs and putting downward pressure on wage inflation. And that's what you've kind of seen. There are some ISM figures for services and manufacturing this week. One was here's prices paid. That ticked down, so that's another kind of shot that the Fed is looking at. That hey, the inflationary pressures are abating a little bit. Now, not dramatically, but a little bit, and that's a start. Now, historically, the Fed has always been focused on growth, right? How do you get growth up, maintain growth, because inflation was always kind of in the 1% to 2% range, and that was fine with the Fed. That was right near their target, around 2%, and they were more worried about undershooting on growth than overshooting on inflation. Now it's the opposite. They made a mistake last year, and they're trying to fix it by having tighter monetary policy, bring down inflation, and they don't care as much about growth as they do about inflation. They don't want growth to be that so bad that you have some sort of economic contagion, market contagion, etc. But so far, you really don't have that. So the fact that prices paid on manufacturing also went down, right? So 87.1 to 84.6, now to 82.2. So on the manufacturing side, you're starting to see a tepid down trend, and that's a bit positive. Now the ISM services PMI, that ticked down to 55.9 from 57.1, still positive, so still showing growth on the services side. And then the manufacturing PMI actually ticked up from 55.4 to 56.1. And Chicago PMI, that also ticked up to 60.3. Durable goods decelerated but still growing. And what this is showing you, see the services being a bit weaker, on a stronger downtrend than manufacturing. And really, this is an underappreciated part of our economy, is that we're bringing manufacturing back to the U.S. After years of exporting our production overseas. So supply chain issues are pushing investment to new production here in America, which is positive. Another positive development, now this is old, this is the March data, so it's certainly stale, but it shows U.S. crude oil production and the price of, basically since after the war started, the company started pumping more. And so this is the highest level pretty much since the pandemic, right? So that was one positive that I saw. So those are the economic numbers overall. And I think for the market, it was modestly positive, right? Slowing price pressures, jobs number, which was fine, but not great. So kind of Fed maybe eyeing that, saying, is that a broader issue? But the overall economy still growing to some degree. So I think for the markets, they were somewhat happy with what economic data they saw today. Now let's dig into the charts here. The S&P really was a consolidation week. That's why I said this consolidation in the market, and it brought a bit of calm. We had that up move. This was Friday. We closed near the highs, and all week, remember this is a holiday shortened week, we really just chopped sideways. We had one very bullish day on Thursday, but other than that, it was a choppy kind of down week, but just eating off time off the clock, really. And that's what happens when you have these moves and you just have what is called an inside bar. So see this bar from Friday, the low and the high. As long as we don't close below the low, it's still consolidation. Now we had one day where we closed above and but came back in. So overall, we're still kind of in this choppy consolidation pattern. The NYSE, that also same type of pattern, kind of right below the 50-day moving average, right below this resistance level, 0.5% retrace from this high. And I still think we get one more surge higher for the next week, 2 weeks. Bear market rallies tend to catch people off guard. And right now, the short-term technicals are bullish, whereas the more medium-term technicals are definitely neutral to bearish. So definitely need to understand where we're at in that cycle. Now, the Russell, that had actually a stronger week. This one also had similar pattern here, but kind of closed basically flat on the week as opposed to slightly down for most of the major indices. And so this also likely, my educated guess here is that we do kind of rally into this 100-day moving average. And I think we're going to retest the breakdown area from mid-April for most of these indices. And I could be wrong, but that's kind of what I'm seeing, especially after this week where you just had kind of consistent consolidation. Now, growth to value had a bit of a rally on Friday and into this week, but today with higher rates, you saw growth a bit of a pullback. So you're going to see these little rally phases for growth doing a little bit better over a week or 2, 3 time frame. But overall, as long as the Fed is on a tightening cycle, rates are headed higher, the dollar's getting stronger, that's bad for the growth side of the market. So here's the 10-year, definitely up on the week, and really I think that's why the market was down. Little Fed tightening policy rhetoric, saying that I think over the past couple of weeks you've had some hinting that the Fed might pause in September, and I think that's what the market's trying to figure out now, is based on the next 2 meetings later this month and in July. Those are almost baked in the cake. 50 basis points, both meetings. Now the next question is September. Right now it's about a 71% chance we're going to have a 50 basis point rate hike in September. How is that going to shift? Is that going to shift more towards 25 basis points, maybe not at all, or kind of stick at that 50 basis point mark in September? I think that's what the market is really trying to decide at the current moment. And a lot of the Fed rhetoric today was kind of positive towards a rate hike in September, but it's really so far off. We still have 3 months, 2 Fed meetings, a bunch of QT, and a lot could happen in that time frame. So that's what the market's really trying to figure out, I think, over the next few months. So you're going to get kind of gyrations in rates and the markets based on how that rhetoric evolves, how the economic data evolves, etc. So yeah, there's that. I want to talk about the volatility index. Is the VIX. What was interesting, and another reason why I think we're still a little more upside near term, the VIX closed near the lows of the week and the lows of the day, up slightly today, but still, this looks like it still does have more downside before you hit kind of major support down in the 2021 range. And so if the VIX comes down, volatility comes down, markets tend to float up. And the same with the NASDAQ volatility index. Here's that. Definitely trending higher than the VIX, but still definitely possibility of some more downside, which means more near-term upside in the market. What was interesting too was the oil volatility index trending down. Look at this downtrend, and that is bullish for oil overall. And same with gold. Gold, not quite as strong of a downtrend, but the gold volatility has not broken out. And as long as this kind of stays below this 50-day moving average, I think you're likely to see more upside for gold as well. So it's always interesting to watch these volatility indexes. I know a lot of people don't, but I definitely do, because it tells me a lot underneath the surface. One thing I wanted to highlight was the KBE to the IAI. This is the regional bank index to the investment bank index. And basically, when this is trending up, there's more money flowing towards regional banks and away from investment banks. And that is risk off. That is a risk off sentiment. Look at here. August, September, right when the Fed pivoted, what happened? The regional banks started to outperform. And that means economy slowing, less IPOs happening for investment banks, less bond issuance, etc. And as long as this remains an uptrend, Fed's on a tightening path and the economy is going to slow, and you want to be in more safe assets or non-downtrending assets, let's just say that. So I thought that was definitely something to call out. Now gold had really a choppy week, nothing really to do after last week's up move in gold. But what was interesting to me was the GDXJ, the junior miners to the GDX. And usually this moves first. And what this is the small cap companies, the very speculative gold miners. Those tend to lead and outperform when you're in a bull market, because that's the riskiest part of the market. And the fact that those are getting a bid over just your normal miners that have cash flow, have dividends, etc., was definitely of note to me. So if this continues, this is a strong indication that gold is probably headed for another leg up. Now the dollar, that had a bit of a choppy week as well. You could call this bearish consolidation a little bit. But overall, the yen, I keep following the yen, and the yen continues to kind of be on this downtrend. So it's telling me the Fed, that one's telling me the Fed is probably not going to pivot. Now, if you look at the euro, that one had a little better strength. So is this saying that the European Central Bank is going to tighten policy more aggressively than what they've said? Whereas the Japanese Central Bank is going to remain in this yield curve control and let their currency basically nosedive continuously. That's kind of what it's telling me so far. So remember, when you look at the dollar index, it depends on what currency you're talking about, what area of the world you're talking about. So I'm definitely watching that, and I do think the yen that's an important currency, and if that continues in a free fall, I think you could see some major fireworks and things breaking in Japan. So that's something I'm definitely on the watch for. And then lastly, let's get to commodities. DBC, look at it, just grinding higher. You cannot name a more bullish chart than that. The agriculture part of the market that pulled back just a tad, but overall, oil, natural gas, it's just so bullish. Even Saudi Arabia talking about pumping more oil, it's not helping oil prices. When Europe wants to ban Russian oil, they passed that rule by the end of the year, and Russia's trying to find places to put their oil, India, China, etc., but they can only sop up so much demand. Remember, Europe is the largest economic bloc in the world, bigger than us. So if they're cutting off, Russian oil, where they get most of their oil from, that is a huge, huge, huge consumer of Russian oil, and so. I see nothing but upside for oil prices. Now, could you get growth scares that brings oil down? Absolutely. But, just every news that you think could ease the pressure on upward oil prices really does nothing. It just shows you that durable strength in that market. So that's where we're at. Interesting times. So much really to unpack, from economic news to Fed policy to underlying market trends. I hope I gave you a good scope of where we're at. It's a bear market, but there are opportunities, and there are a lot of risks. And you just have to be aware of the trends and the underlying trends, and that should help you navigate this bear market much, much better, and hopefully come out ahead. So I want to remind you, the contents of this video are provided for educational purposes only, should not be construed as financial advice or a recommendation to buy or sell a security or to participate in investment strategy. The views are my own and do not represent those of KPP Financial and those associated. I thank you all, and you have a wonderful weekend.